Now, this is the first day of your lecture, financial management. The subject is conducted by three lecturers, myself and Professor Kampa Rajapaksa and Dr. Anuradha. Basically, theoretical aspects are covered by myself, and then some other quantitative aspects. Most of the quantitative topics are conducted by other two lecturers. The subject is financial management. So you can just read the course outline. So here indicate the financial management begins with discussion of financial objectives, including how managers and investors use financial statements to determine how well a firm is meeting its objectives. And investors use financial, and this discusses the financial environment, time value of money, trade-off between the risk and return, how bonds and stocks are valued. On these basic concepts, with this background, subsequent topics explain the financial tools and techniques that are used by managers to help maximize firm value. Included are cost of capital, capital budgeting techniques, procedures for determining the optimal capital structure, the process firms use to raise capital, and various aspects of working capital management. So basically, the topics cover here company level investment, company level financing, and how the company operate their business activities, maintain the assets, maintain business operation likewise. So you know that the subject is based on some other basic financial statement. One is the income statement, other one is balance sheet. So here I will show you that then in a company, basically we report all the account transactions in a company books and records. Ultimately, from the different type of books, they record in a fund. Summarize all the financial transactions and then finally prepare their financial statements. One is income statement, other one is balance sheet. In addition, there are some other relevant document like cash flow statements. Likewise, we can prepare some additional requirements, schedules as we require. So in a company, I will just explain how the financial management relate with the company. In a company, we know every year we prepare balance sheet from all the transactions at some particular time period. During the periods, if there are different transactions, then result in that ultimately company may have assets, liabilities, some other positions. So reflecting that company status, positions, company prepare balance sheet. So in the balance sheet, accounting people know that all the assets are recorded in right hand side of this balance sheet. So here, All the transactions, asset-related transactions are recorded in here, result in that there can be investment side here. Investment. So investment means here two kinds. One is long-term investment, other one is short-term investment. Long-term investment means land and buildings, machineries, plant and machineries, motor vehicles, some other furniture. Likewise, there are different kind of investment here. So similar with that, there are short-term investment also, current assets as well as current liabilities. Then the inventory, debtors, cash balances. From that, we observe what are the different current liabilities. Items are there. Current liabilities, creditors. So we have to pay some to the creditors as well as some other liabilities, accruals, like payable items. Then ultimately, we estimate the net working capital. Net working capital. In taking all the, we call in finance investment. Investment. So if you want to start a new business, then you start with this side, asset or investment. Say for example, you are going to start a retail business. Then for the requirement of your retail business, you decide what are the different kind of long-term assets. Sometimes you have to have some building. Sometimes you have to have some machinery. Sometimes you need a motor vehicle. Sometimes you have to maintain some stocks, inventory. Sometimes during the period you have to go to the people, customers on credit terms, debtors. At the same time, you have to maintain some cash balances for their day-to-day requirements. Likewise, there can be credit side also. There's a items, creditors, accruals, likewise. So, say for example, for this all the inner requirement, you need 10 million rupee investment. Depending on that nature of that business, you need 10 million rupee value. So you first decide this value, but your total investment. We call that firm size. Firm size is the 10 million rupee total investment here. So you decide that one first. If you need 10 million rupee, then you have to think how we raise capital. Sometimes during the past period, you may have saved some money in your bank account, then you can use that. Then you can use your own capital here. Your own capital, some value here. If you have saved some money, say for example, you have savings 6 million rupee only. Then for the requirement of the proper operations of the business, then you need to raise another 4 million rupee capital from the external party. Sometimes you can borrow from your parents, you can borrow from your friends, or sometimes you can borrow from the bank. So, however, if you don't have money, then you can raise from the external market. We call that debt capital. Then ultimately, you have to maintain 10 million rupee value for the business. So now think of that. For the business requirement, you need 10 million rupee investment. Then first you have to decide this value. Depending on the nature of the business, depending on the demand of the market, likewise, you have to decide the total value of the total firm size. That may consist long-term investment, short-term investment. So here, after deciding the debt and equity capital, your own capital and then the debt capital, then based on this one, you can see the total value of the company, value of the firm. Then every time your purpose is to maintain this value. If you have invested now 2022 1st January, if you have invested this amount of capital, your own capital 6 million rupee, you have raised 4 million rupee debt capital, then after 1 year period, do you expect the same value or more than that? Every time you expect more than that. So during the period you can earn some profit and then you can add value to this capital. End of the period, you expect to increase the capital here. Then ultimately you try to expand some value here, add some value here. So here, creditors means in order to maintain the company assets here, long-term assets and as well as short-term assets. For the business operations, we have to raise some capital using the short term. So creditors here, you borrow some money on credit terms. In shorter period, you have to pay that dues. So however, for the day-to-day requirement, you need the current assets, debtors, inventory, likewise, you need some value. And similar way, you can use some external facility here, creditors. We can use the credit facilities. If there are some payables like telephone bills, electricity, rents, likewise, you are not going to pay on the same date. Sometimes there may be a lag. The last month payments can be settled this month. So this month settle can be settled in next month period. Then there's every time 30 days lag. So we use that facility actually. So however, from current assets here, eliminate the current liability. Then, so this the remaining part is your investment in working capital, net working capital. So that is creditors also in some way you are raising capital. Current assets may be investment, current liabilities here, that is the financing source, short-term financing. So this is the net figure, net working capital. So that net figure is the investment. So however, ultimately, end of the period, you expect more value than what you have invested. So initially your own capital, you have invested 6 million rupee, you have raised 4 million rupee debt capital, then end of the period, you expect more value than this 10 million rupee because of every time your purpose is to increase the company value, maximize value of the company through profit or maybe some value additions, then you increase this value. So income statement, every year you prepare some income statement. So in the income statement, or profit or loss account, we report here revenues, expenses, then the residual is the profit. Oh, profit. So this profit we can carry forward to here. Then you can add to this capital. We don't withdraw that profit to your own usage. You can carry forward that for the next year activities, investment. So likewise, every time you observe there's a value increase here. So when you increase the value here, at the same time there's an increase in asset side also. Due to that double entry system, asset and liability equation fundamentals generate the equality, assets and liabilities. So however, every time you expect some value addition to this initial invested capital. So that is the second part. So here, these are the financing. Own capital, debt capital, we call that financing. So likewise, there can be different kind of financing sources. These are the basic financing sources. Owner's capital and debt capital. If it is a public company, there can be preference shareholders, debt, equity shareholders, then debentures, bonds, etc. Different kind of financial instruments here. So here, compared to this capital, if it is a equity share capital, public company, this represents the equity capital. The debt capital may have different type, maybe debentures, maybe bonds, maybe bank loans, maybe some other loan from some other institution likewise. So however, this is called debt and equity. So long-term owner's capital, long-term debt capital. We maintain some balance between these two, owner's capital as well as debt capital. Compared to this owner's capital, end of the period, we have to compensate the investors. We have to give them some profit. We have to give them some dividends. So likewise here, there can be some cost. If you paid some compensation to the investors, shareholders, through dividends, then that is a cost to the company. Then say for example, a cost of the owner's capital, we provide 12% compensation for their investment. As similar with debt capital, say for example, we pay 10% rate. Then ultimately, on average, we estimate here, if it is here the 5 million rupee equity capital, 5 million rupee debt capital, total 10 million rupee, then on average, company cost of capital, that is 11%. Because of this equal proportions here, 5 million rupee, 5 million rupee, then in that case, cost of capital is 11% rate. That is the average of these two, 12%, 10%, 22% divided by 2, then 11% rate. So we call that company cost of capital, weighted average cost of capital. That is weighted on the capital here, capital, debt and equity. Later we will discuss how we derive this 11% rate. However, this 11% is called weighted average cost of capital. For the investors, end of the period, if you raise 1 rupee capital, either using the equity or debt capital, we have to compensate them 11% rate, 11 cents. If you raise 1 rupee, you have to pay 11 cents as a compensation. Maybe dividend payment, maybe interest payment. So, If the company maintain in this manner, have a 10 million rupee assets here, long-term assets, short-term assets, as well as there are some liabilities, owner's capital, debt capital. Then at the end of the period, you compensate the investors 11% rate. Then, if you compensate the investors 11% rate, every year as a business, you have to earn some profit here. What is the minimum profit you require for maintain that investment? If it is a 10 million rupee investment value here, capital employed is 10 million. 10 million rupees. Then in order to maintain this investors requirement, we have to pay 11% cost. Then how much we have to earn annually as profit here? Then every year we have to earn how much? 1.1 million as profit. Then you get the 11% rate. No? If the company earns 11% profit here at least, then we can compensate the shareholders as well as the providers. If you earn more than that, say for example, company earn 2 million rupees, then it means 20% return. Then company return is here. Company return is here 20% rate. It means from the company earn 20% rate. On the other hand, company pay 11% rate cost. Then the company have additional value here, value addition. If the company earns, say for example, less than 1.1 million, say for example, company earn only 1 million profit compared to total 10 million rupee investment. Then your return is here 10% rate. If the profit is here 1 million rupee, then your return on capital employed, ROCE, then it becomes the 10% rate. Then what will happen? On the other hand, you have to pay 11% cost to the investors. You earn only 10% rate. So annually you can make a loss, 1% loss. So what kind of prospect you expect here? Sometimes you can expect 20% return here. You can accept that. 10%, we don't consider that. We have to eliminate that 10% rate and we have to increase the company performance. So here, company cost of capital is some particular benchmark. So this is the different criteria here. If the company cost is 11% rate, from different investment here, there can be different long-term investment here. Motor vehicles, plant and equipment, land and building, like that. There are different kind of investments. So those investment, you can evaluate that, assess that. So capital investment, we can assess that based on this particular criteria is the cost of capital. Then that particular project may indicate their net present value. If you have learned that concept, project appraisal, if the NPV value is positive value, net present value, after discounting taking 11% rate, all the cash flows generated from this particular projects or asset investment, then ultimately that may indicate the NPV value. That may be positive value, that may be negative value. If it is positive value here, it indicates that particular investment generate more return than the company cost, more than 11% rate. If the NPV value less than the 11% rate, then NPV value becomes negative value here. So as a business firm, we don't accept this kind of negative NPV project. So every time we accept only positive NPV projects. Then that projects generate more return than the cost. So if you make some investment in the working capital, inventories, debtors, cash balances, etc. So how we assess that investment? The short-term assets also should be assessed with this particular 11% rate. From this inventory maintenance, you have to make investment. If the inventory value is 500,000 rupee on average, then every year you have to maintain, every time you have to maintain 500,000 rupee inventory. So that is your investment. So from that inventory, we have to generate return than 11% rate. Through sales, trade sales, you can earn some profit. So from this investment, you have to generate more return than the 11% rate. Then that may be feasible. Current liabilities, how much you have to incur here? Then through creditors, you have to use this facility and then you try to generate 11% rate at least. So likewise here, some business investment, then you have to concern different aspects. One aspect is what is your total investment here. Other aspect is what is the total financing. And then if there are different total financing here, you can decide the debt and equity. At the same time, you have to decide what is the appropriate compensation rate, debt providers as well as equity shareholders. And then what is the company level cost or weighted average cost of capital. And then how are you going to assess all these investments, long-term as well as short-term investment based on your cost of capital. If you properly maintain this framework, then you can success in the market. So all the financial management functions, aspects, operations are based on this fundamental requirement. So this is you have to keep in mind this particular framework. So all the topics are covered through this particular framework. So here indicate different topics here. So here indicate the learning outcome also. You can just go through that. Describe the financial environment and its impact on the business. Explain the time value of money concept and its implications. Identify the financing sources and investment opportunities. Now already we identified the debt and equity and some other financing sources likewise. Explain the relationship between the risk and return. Comprehend the concepts and models of valuation of assets. Evaluate the importance of cost of capital, capital budgeting, financial leverage, and working capital. and discuss the different theories, the implications, applications, and empirical evidences in relation to financial management. Then likewise here, pointed out here different topics here, tentative topics. Today introduction part or financial environment overview. Then second one is the financial environment. So as we explained earlier, when we raise capital from the market, we have to interact with the share market. We have to interact with the debt market. We have to interact with the banking sector companies. We have to interact with some other investors, short-term investors, long-term investors likewise. Then we have to think of how to deal with the financial environment. In the market, there are different capital markets, financial market, capital market, short-term markets, long-term markets, and then financial instruments, equity shares, debt instruments, likewise preference shares. Then markets are there, no? The banking companies, some other mortgage, that is also under financial environment. So we have to discuss the financial environment also. And then other main topic is time value of money. In financial management, we concern opportunity cost. What is the opportunity cost? If you invest some money in the business, then you could have earned some return investing in some other alternative. You could have at least earned some profit, some money from the savings in the bank. That is one other alternative. Then you can purchase some shares in the market, and end of the period you can sell it at a higher price, and then you can recover some benefit. Likewise, there are different kind of investment opportunities. So here time value of money concept is very important. Then every time if you generate some cash flows, year 1, year 2, year 3, likewise, there can be a 5-year, next 5-year period, then you can be assess that cash flows based on that opportunity cost. Then you have to deduct some value from your earnings, cash flows, because of the opportunity cost. Already we mentioned that we have to compensate the investors, we have to compensate the debt providers. Then how we pay that compensation? So ultimately, if your cost of capital 11% rate, then every cash flow should be discounted taking that 11% rate. So here, financial environment, then time value of money, we evaluate all the cash flows based on that particular requirement. Then every time we observe what is the present value, what is the future value likewise. If you take business now, we observe what would be the next year value additions. If you know the next year cash flows, income level, after next year's income level, then what is the equal amount in current period, equivalent value in the time period now, then that should be discounted. Future cash flow should be discounted taking company cost of capital. So that part we discuss under time value of money. Present and future and annuities, that part is come under time value of money. Then other topic is risk and return. So why risk? Why return? When you invest in the business, then that is a risk, business risk. Then depending on that different type of business risk, end of the period, you expect some return. If you involve more risk, then you expect more return. If you involve the less risk, then you expect the less return. So different individuals may have different risk taking positions. Some people are they are willing to take more risk. Some people are not taking more risk. In that case, they go to bank and save some money in the bank. Other people who are willing to take risk, they go for some other investment in the share market, then invest in the shares, then end of the period you can recover the selling that securities, and then it can gain some high return. Likewise, if there is an investment, it involves some risk and return. So we discussed the risk and return. Then another topic is the bond and bond valuation, shares and their valuations. Taking both together, bond and shares. Company has debt capital and equity capital. So if you are an investor, every time you observe when you purchase some shares, then you have to evaluate the company share value. If it is reasonable that value, then you can purchase. Likewise, the bond providers also same. Debt providers, they also observe what is the company level bond value or debentures, whether that particular the market prices of that particular bonds are fair. If it is fair, you can decide to invest in the share, debentures. Then every time we observe the shares and bond valuations. As an investor, you observe that equity shares and the debt capital or debentures, whether the market gives the fair price for the company instrument. For that purpose, we need to bond valuation and share valuation. Then other one is the cost of capital. As we explained earlier, when there are different financing sources, at the same time we have to compensate the investors. On average, ultimately, we can estimate what is the company cost of capital. If your business cost of capital you know, then all the decisions are taken based on the cost of capital. Every time you can think of your cost is this much, and then from different investing activities, we can generate more return than that, or maybe sometimes less than that. You can decide that whether it is appropriate or not. Likewise. So, however, as a business, you have to know how to calculate your company cost of capital. That is a requirement, but no, most of the businesses, they don't estimate their cost. They don't follow fundamentals. Then another one is capital budgeting. If there are long-term investment in the business, then we have to make some assessment, long-term investments. Then after assessing that, if it gives the positive NPV, then we can accept that. If it is negative, we reject that. So that part is done, discussed under capital budgeting techniques. NPV, IRR, MIRR, likewise, there are different types. Some estimations are risk-based, others are not risk-based. Likewise, we have to evaluate that projects using that fundamentals. Then another one is corporate valuations. So what is corporate valuations? If it is a business, then every time you must be able to calculate the company value. If you have different types of investment assets, liabilities, then if you have different kind of sources, financing sources, then you must be able to calculate the company value every time. So, like equity share valuation, the valuation likewise, you can estimate the company value also. If there are some mergers, some other company may make a request, may offer you some alternative. They are willing to purchase your company sometimes. Sometimes they can propose to merge with them both. Businesses are merged, then they may have more advantage. So in all the cases here, then you have to evaluate that company. If you know that company value, then you can decide whether to merge or not, amalgamate, or some acquisition. Likewise, you can decide appropriately. For that purpose, we have to make a corporate valuation. Then the other topic is financial decisions, capital structure, and dividend policy. Now we understood basically there are mainly two kinds of finance source. One is owner's capital or maybe equity capital. Then other one is the debt capital. So that is the financing decisions. You can decide whether to generate 100% equity, 100% debt capital, or maybe less than 100% equity, or maybe 50% debt, 50% equity capital. Likewise, you can decide the financing proportions. So that is called financing decisions. Then capital structure. It means the concerning the long-term capital here, debt capital and the equity capital, we consider as a long-term financing source. Concerning long-term finance, we discuss capital structure. In some cases, we use the term leverage. Leverage means debt with debt capital, debt and equity capital. At the same time, you have to concern about how much we can compensate the shareholders, dividend payment, dividend policy. So that is also very important topic, financing decisions, capital structure and dividend policy. Then other short-term financing and working capital management. So company earn a profit depending on their day-to-day operations. If it is a retail business, their day-to-day operations are very important. So if you invest in the short-term investment, inventory, debtors likewise, the short-term financing, short-term investment are very important. Derivatives and risk management. Some instruments value depending on the others' values. And what is their risk levels? That may relate to company instruments. Those are the tentative topics we plan to discuss during this semester. So, get some idea here. Then you have follow some particular procedure here. Some assessment is there. Then end of the semester examination, 50%. From total marks, we allocate for 50% for the final exams. Continuous assessment, 50%. Then 50% continuous assessment consists of three activities you mentioned: active participation, 10%, midterm exam, 25%, one assignment, 15%. So exactly later we will decide exactly whether we can do some active participation, 10%. We can decide later, but however, this is the tentative evaluation method. Final exam, active participation, midterm exam, one assignment. So midterm exam is here, indicate here, 6th week here, 1 hour paper, consisting MCQs, multiple choice questions. Then one assignment later, we will give you some assignment, relevant topics or maybe some guidelines. Then accordingly, you have to submit your assignment. Continuous assessment, midterm exam, individual assignment. Each student is expected to make a report on a topic in finance with information related to his organizations. So relevant to your company, you can prepare some report. Guideline will be discussed in the classroom. Then recommended text, Brian Eugene and Michael Echart. Financial Management Text and Cases, 12th edition or later. So similar with that, there are some similar textbook, same author, text, theory and cases, theory and practice, same authors, but some topics are different in the text. That is based on the more theory. So here text and cases. So here include some case studies also. In addition, there are some other similar financial management textbooks. I.M. Pandey, Financial Management, 2015, 11th edition. The Ross Westfield and Jaffe, Corporate Finance, 6th editions. Those are actually commonly all the financial management topics. The textbook discuss the similar pattern, similar way. So you have to adhere to all the relevant fundamental principles. So those are the things initially we have to discuss. Tentative topics and the requirements, and then the subject, nature of the subject. If you have any questions, you can raise. Then now we can start our initial discussion with the topics, introduction part. So including this topics and some related financial environment part, we consider as a one particular segment here. Plan for this segment is introduction, cost structure, and overview of financial management, and then financial environment. This part we discuss under one particular umbrella. So these are the basic requirements, understanding you must have. So what is finance? So in finance we discuss in different terms. Finance, financial management, corporate finance, business finance. Likewise, there are different usage. So what is finance? If you are a person, individuals, if you deal with some purchase or sales or maybe some other involvements, dealing with some particular activities, so you deal with some particular finance functions. So here indicate finance is a broader terms that describe two related activities. The study of how money is managed and the actual process of acquiring needed funds. So one here indicate the two basic requirement in finance related aspect. One is you concern how money is managed. If you have a income level, if you have a monthly income, then you concern about how you are going to manage your monthly income for the consumptions, for the investments, for future requirements. You can think of how we are going to manage your money, income. Then the second point is that actual process of acquiring needed funds. If you decide to allocate the 20% for your consumptions and the 20% for the future investment likewise, then you can decide what is the actual process. If you have some investment, if you don't have any monthly income regularly, then you can decide how you are going to raise your requirement, fund requirements. Then it involves two kind of aspects. One is how money is managed. The other one is actual process of acquiring needed funds. Sometimes some people may have permanent monthly income. Some other people, they don't have permanent monthly income. Then uh, sometimes they earn ad hoc basis. Sometimes they involve some investment activities and get some return. Sometimes they don't have regular income level. From time to time they have a income. So, however, you have to decide what is the actual process of acquiring your needed funds. You have to plan that. Hence, the study and practice of money, making money denominated decisions. Money based different decisions are your practice, that is the finance. A branch of economics concerned with resource allocations as well as resource management, acquisitions or investments. So in business firms, if you are going to purchase some assets, it means that acquisitions, acquiring investments, allocate some assets for purchase some particular assets, likewise investment. So every time we concern that acquisitions or investment. Similar meaning here, acquisitions or investment. Then main field of finance. Here indicate the three fields: money and capital market, investment, business finance or corporate finance. So every time your finance matters or maybe some dealings are linked with this kind of category here. Maybe money related or maybe capital market related. If you decide to save some money in the bank, that is money market. That may be capital market. If it's a long-term investment, if it is the fixed deposit, then maybe capital market, long-term. If you decide to purchase, invest in the share market, then that is capital market. If you decide to purchase some treasury bills as an investment, then that is money market related, short-term, less than 1 year period investment. If it is more than 1 year period, then that is called capital market related. So that may be money or capital market related. Or maybe that if you decide the investment savings, then we categorize under that investment sector. Investment. You can decide to invest in the business sometimes. You can decide to save some money in the bank. That is also investment. Sometimes your investment may be lending money to other people. That may be your investment. And end of the period, you can recover some interest. So in that case, the lending money is your investment. Then another one may be your activity can be or business finance or corporate finance. So retail business, wholesale business, manufacturing companies, some enterprises, corporations, partnerships, any kind of business activity concerned under this third category, business finance or corporate finance. Your target is to earn some profit. Your target is to earn some value additions. Then we concern the business finance. If you concern it some particular investment in the entire corporations, long-term investment, short-term investment, as well as you may have a long-term borrowings, long-term equity values likewise, then it means that you are dealing with the corporate finance, public companies, government institutions, private enterprises. Those are business finance or corporate finance related. So next one, more important, we have learned different kind of business organization. One is sole proprietorships, then other one is partnerships, then third one is private companies or maybe public company. So in finance, public company or corporations are very important here, because the corporations, public companies, they have some legal system. They have a mechanism. When they raise capital, they have a mechanism. When they operate their businesses, they have some governing system, board of directors. So due to that reasons, actually, corporations or public companies we concern here, very important entity, and we have to understand their different features. One feature is limited liability. If you have purchased some shares of a company, then your liability limited to what you have purchased shares. Then your liability is limited to that the share capital, how much you have purchased. Then the company has some particular governing practices, board of directors. Then they prepare some annual reports. They are governed by some other audit procedures. You have to submit your annual reports to the SEC or regulators. Then it has some permanent features. Then anytime they can access to any market, debt market, equity market, or share market, preference share market, or some other debt instrument. Then they have some flexibility anytime. Then anytime they can raise capital from the market. Not like other sole proprietors, not like other partnerships. They have access to market, capital market. Then other feature is the public company we consider as a legal entity. We consider that company as a legal person. So if you want to make some file some case against the company, then you have to make that complaint against company name. Have a board of directors. The governing mechanism is done by selected directors from the main shareholding, board of directors. Then owners are stockholders.
Recording stopped. Recording in progress.
Sir? Excuse me, sir?
Hello?
Now it's okay, sir.
Maybe muted, no?
Yeah, I think within 5 minutes time, we can't hear your voice.
5 minute time is from
Lord.
okay, doesn't matter. Now, this personal finance, business finance, and public finance, that part is relevant to general area of finance. Then concept involved in finance, any kind of finance activity involvement, it includes three components. One is time, other one is money, third point is risk. If you decide to save some money in the bank, I will repeat that. If you decide to save some money in the bank, then it involves these three components. That may be time dependence. If it is savings account, you can maintain for a longer time period. If you think that your investment is for some fixed amount and some longer time durations without putting to your savings account, you can maintain some fixed deposit. Or sometimes you can, if you have excess income, then you can decide to purchase some shares from market. Then when you purchase some shares, it involves some time period. No? If you are an investor, your purpose is to maintain some company ownership. If you maintain your company ownership, share ownership, then you can maintain for a longer time period. As an investor, you can invest in the shares, and after one month period, after 2 days period, after 3 days period, likewise, you can sell it to other people and you can recover your investment. So that also involves some time period. And then money, how much money you can put it to that particular investment. And the same time, so any kind of activity, it involves some risk level. If you maintain some businesses, if you put some money in the business entities, then it involves some risk. We call that business risk. If you save in the bank, and it involves some risk, no? So it may be investment risk. If you decide to give some money to some other people as a loan, and end of the period you can recover some interest. So it involves some risk, credit risk. Then credit risk is there. Then in that case also, you decide how much you can lend. For how many time period, what is the time duration for that investment. So any kind of concept involve three components here: time, money, and risk. And how they are interrelated. So all these three components are interrelated. So any kind of activity here, it involves three components. Those are interrelated. For example, say for example, if you save some money in the bank, then In that case, you can estimate what would be the value at the end of time period. Then first you can decide what is your deposit value relevant to this particular investment. Then it indicates some particular return. For savings, banking company gives some particular return, 1 plus discount rate. So this discount rate depends on the particular investment type. If it is the risky investment, the return R is higher. Less risky, then return level is low. If you deposit in the treasury bills, then no much risk because you are purchased from the government. Then it involves some lower risk. Then your return level is less. So, like here, if you decide deposit some value here, then that indicate what is the amount of money you can invest, 100,000 rupees. What is the return level? Maybe 0.05, 5% rate. How many periods? Then maybe 5-year period. Likewise, here there can be some particular mechanism. So here this equation involves 3 components. One is time. They indicate the time period, N. Money, how much here money? What is the risk level? This is the relevant to risk level. These parameters are interrelated. So when you calculate the present value, that also involves these 3 components. What is the future value? What is the discounted rate? R, risk level? What is the time period here? Any kind of equations, any kind of investment, any activity involves these 3 components, and they are interrelated. So this represents some particular relationship. Think of that. So every time, as a rational investor, if you try to lend some money to some other people, then you think of these 3 components. One is the risk level, what is the amount, what is the time duration. Depending on that, you can decide what is the particular interest rate you charge. Because every time the opportunity cost is there. Basic level of finance operations. So every time every individuals involve some basic level of operations. At least save some money in the bank, deposit. So here indicate through individuals and business organization depositing money in the bank then lends the money out to other individuals or corporations for consumption or investment and charges interest on the loan. So when you realize that you are saving, so investment, you can remind every time they collect the money from the bank, they lend to other people for different purpose. So maybe consumption purpose, maybe investment purpose, or maybe some other type requirement. But however, end of the period, the banking company charge against your the lended money. They charge the interest. So sometimes the funds can be raised through issuing some shares, issuing some debt capital. Sometimes you can sell your own shares. If you have purchased some shares, then sometimes you can decide to sell to some other people. Then concerning business organizations, we have to think of best performing or successful companies. So every time if you can discuss the investment, business investments, raise capital, likewise, every time you have to think of how the businesses are operate in the market, how they perform best, successful way. Then other idea is what is corporate finance? What are the aspects we concern in corporate finance? Third point is what is the goal of the firm? Do we maintain profit maximizations, or do we maintain some value maximization or value creation likewise? We have to think of what is the primary goal of the company. Then another point is organization of financial management functions. How the different financial management deals with the company operations. Then concerning best performing companies, there are different indicators, criteria. In most cases, the best performing companies are measured based on their revenue, income level. So here indicate the 2008 best performing companies in the world, 2017, and then 2008. And what is their business? Here indicate the Walmart revenues in 2017. Second place, the State Grid Corporation of China. Sinopec Group, third place. Fourth place, China National Petroleum Corporations. Fifth place, Royal Dutch Shells. Toyota Motors. But it indicates here, right hand side, in 2008, their rank. Walmart in 2008 was rank 2, retail business. Then Royal Dutch Shells, 2017 their rank was the 5, but in 2008 their rank was 3. Their business oil and gas. Then Toyota Motors, Japan Automotive, 2017 their rank was 6, 2008 the rank was 5. BP PLC, 2017 8th rank, but 2008 4th rank, oil and gas. ExxonMobil, Berkshire, Apple Inc. Corporations, likewise Samsung. So there are different categories here. So, however, based on their revenue, best performing companies based on their revenues are here. You can search on the website and you can get the idea. Then here indicate the most profitable companies in the world, 2018, depending on their profit level, profitability. Apple, 48.3 million. Berkshire Hathaway, 44.9 million. Version, AT&T, JP Morgan Chase, Comcast, Wells Fargo, Pfizer, 21.3 billion based on their profit. In 2018, their profit based on their profitability, Pfizer company indicate the 8th level. Now you can check on the website now what is their ranking. Then other investment companies, S&P company issue some particular magazine here indicate the Fortune 500 companies. Top 10 most profitable Fortune 500 companies in 2015. That is the investment company S&P, Standard & Poor, they published their Fortune magazine concerning the 500 companies. Among them, they indicate 2015, Apple was the first one. Second, JP Morgan Chase, Berkshire Hathaway, Wells Fargo. Likewise, here indicate the different kind of companies, their level. So now you can think of what is the Sri Lankan companies. 2014, John Keels, second place, Commercial Bank of Ceylon, third, Bukit Dara, fourth, Ceylon Tobacco, fifth place, Het National Bank, Dialogue, Sampath Bank, National Development Banks, Distilleries Companies of Sri Lanka, Sri Lanka Telecom 10th place. So here indicates some based on their income level. So here the financial criteria can be include turnover, revenue, profit after tax, return on equity, earning per share, market capitalizations, value of shares, transacted and value additions. Furthermore, weights are assigned to the criteria without any prejudice. Then here indicate the most respected entities, 2018, based on perception of respondents. From asking some questions and their respondents. Based on that, Nielsen survey reported by LMD Lanka Monthly Digest 2018, based on their responses, most respected entities. John Keels, Mass Holding, Haley's, Commercial Banks, Dialogues, Unilever, Aitken Spence, Brandix, Sampath Bank, Softlogic, etc. So there are different categories, different criteria. So finance people concern the revenue or based on the profitability, or some other HR people, how they consider the most large companies, how they categorize. Sometimes they can categorize based on their number of employees. Number of employees. So, however, anyway, the successful companies, how we recognize in the market. If it is successful companies, we have to identify that and create and deliver products or service that are highly valued by customers. If you think one particular company, John Keels or maybe some other banking company, you can realize some particular way of tendering their services. So if you can recognize, it creates some value, deliver good products and services, highly valued by the customers, then it indicates some particular successful characters. Sell their products and services at prices that are high enough to cover costs and to compensate the owners and creditors for their exposure to risk. From the company side, if it is a successful company, through their product and services and their selling and their prices, selling at their services and prices, then on the other hand, that should be enough to cover their company cost in order to compensate the owners of the company, in order to compensate the stakeholders of the company. If you can think of that, they cover their enough way, then they provide some, we consider as that particular company as a successful company. Satisfying customers and investors are more important for the success of the company. Through their services and product delivering, then ultimately they have to satisfy their customers. They have to satisfy their investors, shareholders. They have to satisfy their employees. They have to compensate the government, providing their taxes regularly and in regular time period. Then that is a successful company. Key attributes required for company success. One is skilled people at all levels inside the company, including leaders who develop and articulate sound strategic vision. So inside the company, there are different levels, the skilled people, top level, medium level, and lower level. There are skilled people. Managers who make value-adding decisions, design efficient business processes, and train and motivate workforces. So the company maintains some workers the efficiency level. They train them, motivate the people. uh, they design the efficient business processes. Capable workforce. Lower level people who are involved in some production aspect, they are capable people. Capable workforce willing to implement company's strategies and tactics. So they realize they get some salaries and they compensate from the company. At the same time, they concern about they have to make some contribution to the company also. They employ they contribute to the workforce through their uh, normal regular work habits, and then end of the period they can get some particular return. Then we can say that that particular company is a successful company. Second, strong relationship with the group outside the company. They maintain some good relationship with the customers, good relationship with the suppliers, good relationship with some other business partners. They indicate the customers, suppliers, etc. Another point, enough capital to execute their plans and support their operations. They have sufficient additional value through their services. Then another point is that our main concern here, financial management. What is financial management? Now read the statement here. Concerns the acquisitions, financing, and management of assets with some overall goal in mind. So this is a brief idea concerning the corporate financial management. What is here? Acquisitions, financing, management of assets. Three aspects. In a company, if you remember the balance sheet model here, balance sheet, acquisitions means this side. There are fixed assets, current liabilities, etc. Then ultimately, you have some particular investment. This is called acquisitions. Early we understood that this is the investment. Other term we use the acquisitions. Already we have acquired some assets. Already we have acquired some current assets. Already we have acquired some current liabilities, suppliers. Likewise here, the concern here, one aspect is acquisitions. Then other one is financing. If you decide here the total investment requirement, if it is a 10 million rupee requirement, then other side you need 10 million rupee financing. For this investment requirement, you have to have 10 million rupee finance. Then you can decide the 6 million rupee owner's capital, 4 million rupee debt capital. So this is called financing. Maybe sometimes here 12% rate, here maybe 10% rate. On average here, maybe sometimes 10% or 10 point something. So this is the financing. We concern here financing, second point. This is the first part. Then the third one is and management of assets with overall with some overall goal in mind. The third point is the asset management of assets. Already we have acquired some assets here. Maybe furniture, maybe motor vehicles, maybe some other plant and machineries, inventories, debtors. Likewise, there are different kind of assets here. Investment. So you have to make proper management system here. Otherwise, you can make a loss. If you maintain the inventory level appropriately, you can earn some appropriate return. But if you are unable to perform well, then there can be some losses. Even from the total assets here, fixed assets, you have to properly maintain that. While operating the businesses, in some case, if you realize that one particular asset is not properly generating profit, not generating some return, what are you going to do? Then you can decide to sell it and replace some new machine, new asset. Then that part also involved in some management of assets. If there are some idle assets, if there are some assets with some generating less return, then you can involve some different criteria. Then ultimately, third point is the management of assets. With some overall goal in mind. So what should be the overall goal here? Overall goal is here ultimately every time you must be able to increase this particular value. Value of equity shareholders, value of debt providers. So now if you have invested 10 million rupee, so next year you don't expect a 10 million rupee. You expect more than that. Next year if your value may be 12 million rupee, with some your profit level or increased value additions, then we have a value additions. Then your overall goal should be to maximize value of the company. Can we say maximize profit of the company? So when you say the maximize profit, it has some limitations. Every time you concern the profit maximize, then sometimes you can decide to increase the product prices. Sometimes you can decide to reduce the maintenance cost. Sometimes you can reduce the employees' compensations. So due to that reasons, we normally don't use the term maximize profit, but we try to maximize value of the company. So it does not mean that if you don't earn profit, in order to maximize the company value, you need to have more, some profit. But merely not, our aim is not to maximize profit. survive in the market and make some value additions and compensate all the group people, participants, employees, shareholders, debt providers. We have to compensate the government, society. Then our overall goal is to maximize value of the company. Without increase the value, we can't compensate any person, any party. Can we provide our goods and services properly to our customers without having some value additions? We can't do that. Can we compensate our employees properly? We can give them incentives, bonuses, likewise, without maximizing the company value. We can't do that. But on the other hand, maximize value, it has some particular level. Ethical considerations are there. We don't mean that we mean that the value maximize, the company should engage in some properly ethical good businesses. So likewise, it has some particular foundations. So remember here, so in some cases we ask some questions, what are the main financial management decisions? Someone can say that one is financing, second one investment, third one management of assets. But here some issue is there. The financial management decisions, there's a priority. One is the investment. First you can start from the investment side. First you can decide the investment here. Then you go to next one, financing. Otherwise you are not starting with the financing. So without a proper target, we can't start with the financing. If you have a business idea, then you can decide what are the different kind of assets you need. Then for the total requirement, then you can decide to raise capital from the owner's capital or debt capital. That is the proper way. Third point is the overall goal in the management of assets. So when you read the different textbook here, the financial management functions can be explained in different way. Sometimes the textbook can explain there are main two kind of functions. One is investment. Second one is financing. No other than that. So what happened to this management of assets? Then if you concern the investment here, then it involves management of assets also here. Then second one is financing. Some other texts explain investment, financing, management of assets like here. Some other texts may explain one is the investment, second one is financing, third one is working capital management. Why working capital management? Because company's main operations involve working capital, day-to-day operations. Company earn profit, company earns some extra value from this day-to-day operation, working capital management. So due to that reason, some companies, some authors concern the more important functions or the investment decision is the working capital management. In that case, what is the management of assets? That aspects concern including investment. Then if you are relevant to the inventory management, debtors management, that involving working capital management aspect. Some other textbook may explain one is investment, second one is financing, third one is dividend decisions. Dividend. Because the company owners invest in the company and maintain the company. Due to that reasons, end of the period, we have to compensate the main owners of the company. Due to that reason, they can categorize first one investment, second one financing, third one dividend policy. So in that case also, management of assets involved in investment side here. So this is the one particular framework we have to keep in mind concerning the business operations, financial management, or corporate finance. This is the entire things, no? For the entire company, investment, financing, how they operate the business activities likewise. In that sense, we call that corporate finance. How the corporations maintain their investment, financing, and other activities, related activities. So keep in mind that then difference between the financial management and accounting. So normally accounting is normally record keeping. If there are some transactions, then we have to report in the books and accounts. Then ultimately, end of the period, we prepare the financial statements. But in financial management, we make some decisions based on the reported values. So here indicate accounting is generally record keeping, historical. Those are based on the past events. Finance is generally about the decision making, users forecast, and therefore forward looking. Every time financial management or CEO concerned about the what would be the next decisions, next period or next year. What should be the some particular level of positions of the market. So that is forward looking finance. So this is interrelated actually. Accounting and finance is interrelated, but there are some deviations. Then concerning the each decisions here, investment, financing, management of assets, taking each component, each decisions here, it has some discussions here. Investment decisions. Most important of the three decisions. What is the optimal firm size? We identified here total value of investment here, optimal size. If you decide the appropriately, what is the long term, what is the short term, if you have appropriately allocate the resources among these different assets, then we call that optimal size of the business. What specific assets should be acquired? What are the particular assets long term? What are the specific assets short term? Third point, what assets, if any, should be reduced or eliminated? If there are some particular assets not generating appropriate returns, then you can decide. You can decide to eliminate from the business and replace with new one. So here we concern the investment related three important reasons. One is what is the optimal size. Then second one, what specific assets should be there. If there are some eliminations, if there are some idle assets not generating appropriate return, then we can take some actions. Second point, financing. Determine how the assets left hand side of the balance sheet will be financed right hand side of the balance sheet. How the assets are will be financed. Then concerning the financing side, this side, financing, then we decided here equity capital, debt capital, likewise. Here indicate among the financing decisions here, there are first one is what is the best type of financing? What is the best type? If it is a public company, owner's capital is the best one. If it is a partnership, partner's capital is the best one. Sole proprietorship, then best type of financing is the owner's capital. So why we say that? In some case, if it is a public company, the most appropriate best type of financing is should be we can say that equity capital. So what will happen? We don't maintain best type financing type here. The company can maintain sometimes 80% capital using the debt, 20% using equity capital. Can you recommend that? So people may think the company running at the expense of the debt providers, because the more capital consists of debt capital. So what will happen if the company maintain 100% equity capital, 0% debt capital? Can you recommend that? 100% equity capital? No. Why? If there are some alternative ways of raising capital at a lower cost, issuing the debt instrument, we can raise capital from the market. In such a case, if we maintain 100% equity capital, then that is not the appropriate. Then you have to use the debt facility. If the people are there, they are willing to provide the debt capital at some particular reasonable rate, then we have to use that. So, however, maintaining the debt and equity propositions here, proportions, we can maintain more appropriate capital is the owner's capital. Owner's capital may be sometimes 70% equity capital, 30% debt capital. In that case, no one makes some argument, because the company maintained with their major parties from their owner's capital. No one can say that the company may run their businesses at the expense of debt provider. We can't say that. They are not going to ask some additional interest charges next year when they renew their debt capital. If you maintain best type of financing is equity capital. Likewise, we can argue taking the partnerships. We can argue with the sole proprietorship. Then first one is that we have to decide what is the best type of financing. Depending on their nature, we can decide what is the best. The second point, what is the best financing mix? Then between these two, there should be some particular mix, percentage, optimal one. We call that capital structure. Debt and equity capital, equity and debt capital. Between these two, 80%, 20%, maybe 60%, 40%, or maybe 40%, 60% likewise. Anyway, we call that capital structure here. How the capital consists of debt and equity. So among the different proportions, there can be optimal mix. There can be not optimal. If it is optimal, then maybe sometimes 60% equity capital, 40% debt capital. Optimal mix. Then we have to decide that what is the optimal proportions here, mix. Best financing mix. Third one, what is the best dividend policy? If you decide the main fund providers are equity shareholders, we have to maintain some best type of financing. Then we have to maintain the best compensation rate also. For them, we have to compensate appropriately. So how we decide the best dividend policy? Different companies may have different policies. Some companies, say for example, one particular company is there, it involves more highly important, highly tax-paying shareholders. If there are 10 shareholders, out of these 10 shareholders, the 8 shareholders may be sometimes paying the taxes because their income level is very high. In such a case, do we consider high dividend payout ratio? You can decide the best dividend policy. Out of if the earning per share is 4 rupees per share, out of that the company can decide to 80% dividend payment, 320 per share dividend. Can we expect this, that is the more appropriate dividend payout policy relevant to this particular company? Owners of the company consist of major part paying the taxes to the government. Normally, if they pay their taxes to the government, normally from their dividend income also, they have to pay taxes. In such a case, those investors, those equity shareholders, owners, they are not willing to take more dividend payment. They expect some lower dividends here because from their any kind of income they have to pay taxes. In such a case, they are willing to invest in the same business, and next year they can earn some higher value. Likewise, their dividend policy may reflect the low dividend payout. In some other cases, in the company, say for example, there is some other company, their shareholders are, most of them are, 80% of the shareholders are not paying taxes. Yeah, maybe small investors. In such a case, the investors every time they expect some kind of return. In such a case, make some analysis among the shareholdings, what their positions and their percentage likewise, and then you can decide the better to compensate them at some higher rate. In that case, that is 80% dividend payout ratio may be more appropriate. Otherwise, the investors, shareholders, they are not expecting to maintain their share ownerships. If the prices are very high, then they promptly they tend to sell that shares and avoid the shareholdings. The third point is finance decisions. Third important is what is the best dividend policy. Fourth one, how will the fund be physically acquired? If you decide to issue some equity shares, if you decide to issue some debt capital likewise, then next step is you have to decide what are the physical process steps you have to take into acquire that required funds. If it is the equity share issues, then it involves some particular process. No? But if it is the debt issues, maybe some bank loans, then it does not take much time. You don't need to prepare some particular company level estimations in such a case. Asset management decisions. How do we manage existing assets efficiently? Sometimes you can decide to maintain some assets registry. If there are a large number of items, assets involved in that business operation, then you can maintain some assets registry. If it involves some particular large number of customers, so there are different kind of inventories are there. Then you can maintain some different inventory levels. Then you can decide the different operating activities. Financial manager has varying degrees of operating responsibility over assets. Then a financial manager, so CEO, should decide the different activities over there operating the assets. Greater emphasis on current assets management than the fixed asset management. That is obvious. If it is a business firm, then they generate profit or valuations through their current asset management. Then you have to properly maintain, you have to make more emphasis on the short-term assets than the fixed assets. Then other aspect is contractual model of the company. Company level, it involves some different persons. Contractual model. The shareholders, they provide shares, share capital. They provide the debt capital, maintain with some particular managers. Because there are a large number of shareholders, no one can involve physically the business operations. Then they can hire some, select some particular directors as a board of directors. And then the board of directors acquire some different managers, production manager, marketing manager, etc. in order to perform different areas. Then the company involves some managerial positions, managers. Then other level, there are some employees. Then other side, from the company, we have to provide some good services or product and services, customers. Then we have to satisfy them. Then every time, if the company generates some profit, then we have to pay taxes to the company, government. If the company maintaining some particular society, environment, you have to adhere to some ethical practices. Then, so however, the companies may have some different contacts with different people. So every time, company should concern that. We have stakeholders and stockholders, we have some customers, we have some employees, we have managers, we have some society. We operate our businesses in the society, so we have to make some social responsibility activities. We have to properly engage the production facility processes likewise. So it has some particular standard practices. So here we call that contractual model of the company. With different people, we have a different contracts. So we have to properly maintain that. If you take, say, for example, if there are customers, if there are some owners of the company, shareholders, sometimes if you try to satisfy the company owners of the shareholders, at the same time, you have to satisfy the customers also. Otherwise, what would be happen? One side you can satisfy, other side you may have some other opposite thing. There may be some contradictions. So you have to optimally balance between different stakeholders. You have to get the service from the employees while giving them appropriate salaries, appropriate compensations. So in the meantime, we have to give them some particular medical facilities. So there are risks involved. Likewise, there are different obligations, contractual model. Contracts may be explicit or implicit. Sometimes someone can be directly, someone not directly. Between the shareholders and the company, we have a direct contract. No? With the providers, we have a direct contract. So we have to give them interest payment properly. Between the customers and the company, not directly. But what will happen if you don't satisfy our customers? We're not providing our goods and services to the customers regularly. What will happen? Can we maintain in the market? We can't. So we have to think of that. Some contracts may be explicit, sometimes those are explicit, direct or indirect. Contracts may also be contingent on particular future outcomes. Sometimes if there are some disagreements, like maybe some other some cases, court cases, then there can be some, they are asking some compensations. Due to that different reasons, different outcomes, the contingent claims can be happen. Sometimes we have to pay them more gratuity, compensations, depending on the request. The model recognizes that conflict of interest may exist between the various stakeholders. So due to that reasons, you have to understand between different parties there are different contingent claims, contingent behavior. The company owners may act on behalf of their benefits. Sometimes they can think of the company purpose is to maximize value of the company. But managers, how they realize their role. Sometimes they may realize they have to maximize company profit. Otherwise, they can't secure their jobs. Likewise, they can think of that. But when you say that the owners of the company, shareholders, their target is to maximize value of the company. The managers, they try to maximize profit of the company. So if there are different idea, interest, then in some particular case there can be contradictory behavior between these two parties. For example, some particular case, the if the company wants to increase their cost, increase their price, the managers may think of through that increase in the the product prices, uh, they can involve some earn some profit, earn some value. But the shareholders, they think a different way. The increase the product prices can be for a short time period, but the company plans policy should maintain properly. So due to that reasons, they can decide not to increase the product prices for a temporal changes. In that case, their target is to maintain in the business. So for a shorter time period, they may have some losses sometimes. So in that case, between the managers and the board of directors, there can be some particular disagreements. So that can be happen, disagreements. So that is called conflicting behavior between the managers and the stakeholders. So here indicate the different set of contracts: bondholders, employees, environment, common stockholders, society, customers, government, preferred stockholders, community, creditors, managers. Likewise, there are different parties involved in the company. So how the company perform if there are such large number of stakeholders? Then concerning the different participants here, asset allocation approaches. When they decide the different decisions, then they can concern the different approaches. One is participant approach. Firm has good understanding about the various participant groups. All participants are equally important for the firm existence, and all of them share the rewards. Equity shareholders, as the legal owners of the company, are not given any precedence. Managers are act as being to arbitrate among the different groups, to allocate resources in such a way to ensure the continued existence of the firm by sharing its rewards appropriately. So this approach, we call that participatory approach or participant approach. So in that case, the company can think of all the groups, all the parties involved in the company. So how we recognize their approach? Second approach is unitary ownership. Focus on suppliers of loan and equity shareholders. Evaluate investment opportunities and financing options, focusing on value maximization objectives. Creation of value. So here we concern only the debt providers, equity shareholders. Other parties are not much important. So how we recognize this kind of approaches, what kind of approaches the company follows? So you can read the company mission statement. Mission statement may explain what is their approach. We can recognize sometimes. Sometimes the company mission statement may include company maintain the value creations. The equity shareholders value creations through customer satisfaction. That may explain one side is they focus the company owners, shareholders. On other side, while satisfying the customers through a good and product and quality service, the concern is there. Some other parties, some other companies may explain company plan is to make value additions while satisfying all the stakeholders of the company. Then when they say that all the stakeholders include all the parties, in that case they follow the participatory approach. When they mention that the equity shareholders value creations through customer satisfaction, they focus the equity shareholders. They can satisfy them through the providing some goods and services to the customers. They ignore the other parties. Not exactly ignore that other party, but their main focus is some particular group. So that is one particular idea about what is the company level approaches. The another point is that what is the primary goal of the firm? Sometimes you can say company level objectives can be different kinds. You can say the maximize profit. Sometimes you can say that minimize cost. Sometimes you can say that beat the competitions. Sometimes you can say that minimize risk. Likewise, there can be different objectives, different kinds. So concerning each item here, all these objectives we can categorize into two. One is maximize company value. The other one is minimize company risk. If they profit maximize, then that relates to maximize value. If say cost minimizations, then you try to maximize value. If you say the beat the competitions, then it means the minimize risk. So sometimes there can be directly mentioned that minimize company risk. Then that involves the minimize risk here. Likewise, all the aspects are we can categorize into these two. One is maximize value, other one is minimize risk. Taking these two, company maintain their risk level as well as they can maintain the company value. Taking these two components, we can say primary goal is to maximize value of the company, maximize shareholders' wealth. Sometimes we can use the term shareholders' wealth. Otherwise, in other cases, we can say that maximize value of the company. But if you go into more details, if you further study regarding this particular shareholders' wealth and the value maximization of the firm, then this particular further discussions can be taken place, but initial level, we concern these two are same. But if you go into details, it has some differences. Shareholders will maximize value of the company. So maximize value of the company, it consider both debt and equity providers, other parties likewise. When you say shareholders' wealth, we concern some particular owners of the company. But in generally, we consider at the initial level, both are same. Our goal is to maximize value of the firm, shareholders' wealth. Likewise, we can mention that. This principle assumes that wealth is created lawfully and ethically. Then you have to think of every business operations, they have to maintain their operations more lawfully, according to the law and regulations, and as well as ethically. So they have to have good practices while taking the service from the employees. Likewise, it concerns some particular lawful and ethical business practices. So if you follow the law and ethically, in most cases, their profit level or maybe some valuations can be sometimes some particular level. Sometimes maybe maximum level maybe profitability maybe 20%. 5%, 20% likewise. So it has some particular range. So here indicate another one in the when you say the maximization of wealth, it has some particular features. Wealth maximization's objective concerns timing and risk of the benefits. As we explained earlier, any financial management decisions may have some time consideration, risk consideration, money consideration likewise. It has some time and risk. It has some conceptual foundations. So when you say that value of the company, it has some particular estimation method here. Free cash flows discounted at taking 1 plus company cost of capital at time period T likewise T1 to N. So this is one particular estimation foundation. So that's why it has a conceptual foundations and impersonal objectives. Not depending on the personal objectives, it has some company level, it has some broader objective. Avoid high level of risk. If it is a ethically a lawful business, then we maintain some particular level of risks. Then it does not involve high level of risk. Encourage to pay dividends. Every time they concern to pay dividends. Growth oriented. So every time you can observe from year to year, there is some increase in company value. Year 1, firm value, year 1, firm value, year 2, then maybe more than that, maybe third year value at the third year, then maybe more than that. Likewise, there is a growth oriented, more creation value. Focus on share price, share market price. Every time company earnings, we can say that earning per share, the company price of shares, every time that is correlate. When the company earn more profit for the shareholdings, then market give the higher price for the company shares. Every time that is correlated. Then shortcomings of alternative perspective, like profit maximizations, maybe earning per share maximization, that those are the alternative methods. It has some different limitations. Concerning profit maximizations, maximizing firms' earnings after taxes problems would increase current profit while harming firms. Then we can increase the product prices. We can reduce the maintenance cost. Sometimes we can issue issue common shares to buy some short-term securities. That may be inappropriate decisions here. Ignore changes in risk level of firm. Earning per share. That is also some other alternative. Problems does not specify timing or duration of the expected return. Ignore changes in the level of risk. Calls for zero dividend payout. Every time we try to maximize company earning per share without paying dividends every time, they try to maintain in the earn profit in the same business investment. And next year we expect the high return earning per like that. Strength of shareholder wealth maximization. It takes account of current and future profits, earning per share, the time, duration, and risk of profit and earning per share, dividend policy, and all other relevant factors. Thus, share price serves as a barometer for business performance. So it does indicate that shareholder wealth maximization is the more appropriate than the profit maximization. Those are supportive evidences. Then modern corporations, shareholders, other side managers. There exists a separation between owners and managers. Stockholders elect a board of directors. From different stockholders, we select the board of directors. Then the board of directors then hire managers or officers. Then role of management. What is the hired people's role? Management acts as an agent for the owners, shareholders of the firm. An agent is an individual authorized by another person. Then the managers are hired at some particular agreed conditions. End of the period, they get the salary. They have to act in the shareholders' best interest. Then there's a famous theory, agency theory. Jensen and McLean developed a theory of the firm based on the agency theory. Jensen and McLean, 1976, theory of the firm, managerial behavior, agency costs, and ownership structure. Journal of Financial Economics, number 3, October, page numbers. So if you want to refer this particular journal, then these are the references. Then in addition, there are some other theories, some similar explanations, research work, Joel and Demesky, 2003. That paper was Corporate Conflict of Interest. Journal of Economics Perspective, number 17, sprint, page numbers. Then agency theory is a branch of economics relating to the behavior of principals and their agent. So in this case, company level principals are board of directors or shareholders. Then their agents are managers. So managers should act on behalf of the principals. That's the role. But practically, there can be some particular conflicting behavior, divergent behavior between these two parties. Principals must provide incentives so that management acts in the principal's best interest and then monitor results. Incentives include stock options, perquisites, and bonuses. In order to eliminate that agency complete divergent behavior, there are different alternatives. One is stock options. The company can give some shares to the managers. Then they also become the shareholders. Then they become shareholders or owners. Then they may have a similar interest. Then sometimes the company can give some perquisites, facilities to maintain their roles, and some bonuses, financial incentives. Sometimes that may give some particular training, and then they can discuss what should be their goal and their roles, and then ultimately the target may be to come into some particular agreement relevant to their roles. Then the other aspect is social responsibility. Wealth maximization does not preclude the firm from being socially responsible, as we view the firm as producing both private and social goods. Shareholder wealth maximization remains the appropriate goal in governing the firm. So even if if you involve the social responsibility, maximization of the company wealth remain the appropriate way in order to do that particular social responsibility work also. Then organization of the financial management functions. The one typical organization may have this kind of functions: board of directors, president, vice president operations, vice president of finance, vice president marketing. In addition, there can be vice president production, likewise, operations management, likewise. Organization of the financial management functions. Under vice president of finance, two officers, treasurer and the controller. Under treasurer, capital budgeting, cash management, credit management, dividend disbursement, financial analysis, pension management, insurance, tax analysis. Under controller functions, cost accounting, cost management, data processing, general ledger, government reporting, internal control, preparing financial statements, preparing budgets, preparing forecasts, etc. So in some exactly we can't explain the same way, but practically, depending on the different circumstances, we can observe different organizational chart. Here also we indicate the hypothetical organization chart: board of directors, chairman, president, chief financial operating officer, vice president of and financial chief officer, treasurer, controller. Those are the things under introduction part we are to concern. But practically very important aspect, if you go into details, then selecting any particular research area, if you are interested in doing some research work, sometimes that particular points may be very important. Concerning company decision making, financial decisions, these categorizations, their framework is very important. Likewise, think of agency theory means even though managers should act for the best interest of shareholders, they act according to their best interest. No, that actually the agency theory explains even if you hire some particular persons, say for example, the company hires some HR manager. So, what is the role of HR manager in a company? say for example, if the hired manager, HR manager, they can maintain the employees' attendance, their performances, their compensation. Likewise, they can maintain some records. So if the one particular employee not much appropriately perform well, their contribution not much appropriate to the company level. So depending on the different circulars, then some particular procedures, they can act on behalf against that particular employee. They can take some actions. But from the other side, if you concern about all the participant stakeholder perspectives, do we consider for some particular, there can be some changes in some particular decision-making conditions for a temporal environmental reasons. There can be something happen. So, do we take the actually that particular employees misbehavior, maybe not performing well? Do we take the action immediately? Tactically, theoretically, that can be happen, but practically, sometimes we have to allocate some time for some adjustment. Likewise, or otherwise, maybe say for example, one particular there is some particular company X. There is similar company Y. This is our company. Company X manage, say for example, their managers. There is some particular proposal from the company Y. Mergers and or maybe some acquisitions. Say for example, this is the large company. Their shareholdings or maybe some company market positions can be maybe 70% of the market share. Company X maybe around 30%. So in this particular case, company Y make a proposal to the company X to acquire this particular company X. Or maybe sometimes mergers, maybe acquisitions proposals. So in that case, say for example, company X company share prices maybe sometimes maybe 24 rupees per share, fair price. But company Y propose maybe 150 rupees per share. The fair price is 24 rupees per share, but company Y propose make a proposal to acquisitions, but in that case, for the one shareholdings, they give 150 rupees per share. So the managers may think that, so the 24 rupees now, the shareholder, they can get 150. Then there's 126 value additions to the company shareholders. Due to that reasons, the managers may support to this particular proposal. So as a shareholder, as a director of the company, do you agree with this particular proposal? Sometimes you may disagree. Why? Because now the per share price may be now 24 rupee, but you maintain the business for a next 5-year period. Sometimes the per share value can be more than that 150 rupees. Then after 5-year period, if you perform well in the market, sometimes your share price can be per share value 200. Due to that reasons, the board of directors or owners of the company, they may reject this kind of proposal. But managers, they accept this one. They are giving some positive arguments. Then there's a conflict between the managers and the board of directors. There's a conflict. So this is called agency conflict. So at the same time, when there's an agency conflict, there's an agency cost. So after 5-year period, if could have been here, the value can be increased to 200 rupee. In that case, if the managers propose the 150 is more appropriate offer, then between the 150 rupee and the 200 rupee, now offer price is 150 now, but after 5-year period, it can be 200 rupee per share. Then the per share value addition could be 50 rupee per share. Then here, if the shareholders, board of directors, according to the manager's argument, if they accept this proposal, what could be happen? Then after 5-year period, they could have lost 50 rupee per share. So this is the 50 rupee per share is a agency cost here. So due to that reasons, then every time the managers should think some particular way, rational way. That may be the shareholders or board of directors idea may be more appropriate one. So theoretically, that can be some other things. So likewise, the agents, they have to act on behalf of the main shareholders. So there are different complicated the particular examples regarding this particular case actually. Agency cost and agency conflict and agency cost. In some other cases, if the company directors hire some particular manager, they can hire some particular persons, and according to the particular way of analysis, unfortunately, if one particular manager, say for example, if they accept one particular investment project inappropriate way, among the different projects, there can be project X, project Y, Z likewise. So project X may be positive value here. Project Y also may be positive value, but here X value can be more than project Y's value. So this is based on the manager's estimations. But inaccurately, if the manager has calculated inaccurately and select the second alternative one, not the appropriate investment. In that case, what will happen? If the manager involves some different analysis and make some inaccurate decisions, unfortunately, if the managers or the company accept that inaccurate decisions here, due to that reason, there can be underinvestment. No? Underinvestment. So if there's an underinvestment, appropriate one is the project X, but they have accepted project Y. So inaccurately, or however, if they have accepted that kind of inappropriate investment, from that there can be underinvestment. Through that, ultimately, actual result could be losses. Actual return could be less than what you expected. In that case also, there is an agency agency cost. So there are different arguments, different applications regarding that agency cost and complete. So even now government side between the different parties, maybe between the president and the prime minister, or between the prime minister and some particular ministry's chairman, or maybe between the chairman and some other secretaries, there can be different conflict. So that conflict arises due to this kind of things. So in corporate finance or financial management, agency conflict arises due to mainly two reasons. One is when the company raises capital, there can be agency conflict. So in some other cases, when the company managers operate their activities, in that case, also there can be agency conflict. So agency conflict at corporate level can be arise due to two reasons. One is when the company raises capital from the market, then that can be arise different conflict. Inappropriately, if you select some issues, in that case, that can be conflict. Likewise, the sources can be different. So if you have any questions regarding the agency conflict and the problems, there are a lot of issues, a lot of discussions. So now we can stop the sessions. So next time we can discuss the environment, how the companies interact with the system, financial system, and financial institutions. So if you have no any other questions, we can stop now.
Thank you so much, sir.
Okay, thank you very much.
Thank you, sir.
Okay.
Thank you, sir.